Hello, welcome to Morningstar Investment Management's webinar. We'll just wait a moment whilst the participants are joining the call. Thank you. People are rapidly joining the webinar, so we'll just hold a moment and begin shortly. Let's get underway. Hello, I'm Martin Coyle, Head of Business Development for Morningstar Investment Management Europe. Thank you for joining us for today's webinar, 4 key themes set to impact advisors in 2022, our last one for the year. But before we begin the session, a little bit of housekeeping as we have CPD associated with the presentation. The learning objectives. At the end of this webinar, you should understand how we form expectations about the future and how these expectations are expressed in the portfolios that we manage. Now, the CPT certificates will be emailed to you within 24 hours of completion of the webinar. And importantly, as always, you can submit questions at any time by using the Q&A button at the bottom of your screen, and we'll aim to address these at the conclusion of the presentation. And of course, when you receive your invite, you can also ask questions in advance, of which we've received some today. We're also recording the webinar, so we'll email a copy to all registered participants. We're just going to start with a poll question, if I may, so a little bit of audience participation. The poll question that you'll see on your screen: which of the following provides the biggest challenge for you in 2022? Protecting against inflation, managing client assets during drawdown, finding sources of income, or accessing reasonably priced investment opportunities. Starting to receive the votes from the attendees. I'll close the poll in 20 seconds. We'll end the poll there. And the results, well, it seems inflation is a hot topic still. So 41% of advisors, the biggest challenge is protecting against inflation going forward. 35% see the number one challenge as managing client assets during drawdown, 18% on finding new sources of income, and 6% accessing reasonably priced investment opportunities. Thank you very much. Helps frame some of the discussion for today. Now, I will just remove those results. Unfortunately, we had to change speakers for today, but fortunate for us is that we've been able to secure our Global Chief Investment Officer, Dan Kemp, to discuss today's topic and answer any questions you may have. So at the outset of 2021, we said expect storms ahead, and markets experienced quite a rocky year. However, investors still managed to secure some healthy returns. Now we look forward to 2022. So to discuss this and more, I'd like to welcome Dan Kemp. Hello, Dan.
Hello, Martin. Hello, everyone. It is wonderful to be with you. And as Martin said, I've stepped in. So do bear with me, particularly because I'm currently based in our attic. I've got COVID at the moment, so I'm isolating from the family. So I'm like a crazy old man upstairs. But the internet's not quite as good here as it is downstairs. So if I drop out, I'll apologize. I'll drop straight back in. But that might account for some internet challenges as we go along. But hopefully not too many. Now we've got a lot of work to go through, and half an hour to do it. So we'll go through pretty quickly, but please do keep those questions coming in. We'd love to spend some time answering those at the end. And so when we think about 2022, then alongside the big topics that you have in your head as expressed through those polls, there'll be lots of questions you have as you think about the future. Martin, why don't you go on to the next slide, if that's okay, and we'll have some of those sort of questions there. So these are some of the things that you might be thinking about. So are we at peak levels of speculation? What about rising interest rates? What about the fact that emerging markets look better than developed markets? All of these things go around the heads of investors. And as we look forward, then as humans, we're constantly trying to find the answers to these questions. We assume there can be answers to these questions, and so we are drawn into the idea of making forecasts. And of course, this is the time of year when people tend to make lots of really confident forecasts about what will happen in the year and years ahead. Investors are particularly guilty of this. There's no shortage of investment gurus who will tell you what they think is going to happen in the year ahead. But actually, we don't think that's a very good way to approach the investment conundrum. And that's because, firstly, nobody's got a very good track record at forecasting. And that's because the future is uncertain. It encompasses a very wide range of potential outcomes, any of which we could find ourselves in 2022. And so as investment managers, our role is not to forecast the future. Our role is to build portfolios for your clients that can cope with a wide range of futures. So of course, if we've been here in 2019, there's lots of topics we've been talking about, but a pandemic and the subsequent economic impact was probably not one of those. It was one of the possible range of outcomes, but not one that anyone was concentrating on. But of course, that's what's dominated for the next 2 years. And as we look ahead, my guess is people are far more focused on a pandemic now than they were 2 years ago, but arguably it's less relevant now than it was 2 years ago in terms of impact. And so be very, very careful when thinking ahead. Focus on portfolios and focus on building robust portfolios that will see your clients through whatever the future holds. And so instead of starting with a forecast, let's start with some objectives. So Martin, if you could go on to the next slide, please. There we go. And so as we go into 22, we thought about really 4 key objectives that are likely to be in the minds of your clients, and these correspond, of course, to the poll that you answered earlier. So we've arranged in a 2x2 grid, 2 that have a defensive focus, 2 that have a growth focus, 2 that are around protecting and growing your capital, and then 2 around the purpose of money, so how you're using your capital. And what we've done with these objectives is taken our research, applied them to these objectives and some of the challenges that face us when we are addressing these objectives. And then we've compiled that all in our 2022 Outlook, which is due to be published next week. And of course, we'll send you a copy as that comes along. So although we'll go quickly today, and we'll only scratch the surface of a couple of these, if you want to dive more deeply, we'll have that heading your way shortly. And then if you have any questions following that, then please do let us know. We'd love to help. So that's the objectives. Now, what are the things that are going to get in the way of those objectives? So Martin, if you move on again, please. There we go. Well, these are the things that are going to get in the way of those 4 objectives. Low bond yields, particularly when we're thinking about income and dealing with potential falls in the market, so a potential market crash. Inflationary shocks. So again, we saw in the poll that inflation is top of mind for so many of you. And so that's a key challenge as we go forward, a challenge that we haven't dealt with in the same way really for more than 20 years. But again, inflation is subject to a wide range of possible outcomes. So we don't want to get anchored on any one possible outcome there. But we're going to focus on that in this webinar. And then pricey markets. How do we deal with the fact that asset prices are really high, and what impact can that have on the probability of the different outcomes ahead of us? And finally, people living longer. Of course, the longer someone lives, the longer their capital has to last them. The more that return is important, and the more the erosion impact of inflation is important, and therefore the real return, the difference between the return a portfolio is able to generate and the impact of inflation, the more important that is. So when we're thinking about the future, instead of making forecasts, let's think about it in terms of these risks, these things that can get in the way of your clients hitting their longer term objectives, and how can we address these? How can we build a portfolio that is robust to these different outcomes? And that's what we'll turn to now. So Martin, if you can move forward, actually 2 slides, because the next one's just an opener. We're going to focus on diversification first. And this is one of the biggest questions I get asked at the moment. Well, bond yields are very low. Are government bonds still an effective diversifier, particularly when we think about the impact of inflation? And of course, people have dropped into the mindset of, well, we've got higher inflation. Higher inflation means higher bond yields. Higher bond yields means falling prices. And so if we expect bond prices to fall, then that's really not an effective form of diversification. And the chart here shows that we've had that rise in inflation in green, but it hasn't really impacted either short-term rates or longer-term rates yet to a great degree. And so there's plenty more to come potentially. But as we think about the diversification from government bonds, then the first question we ask ourselves is, well, is it the most effective diversifier, or there are other more effective diversifiers? But equally, when do you need a diversifier, and will it help you in that particular environment? And so when we think about government bonds, then yes, we agree that bond yields are far too low. We've talked about this for a long time. Bond yields are far too low. They don't represent an attractive investment, but they are probably still an effective diversifier. And why is that? Well, because if you're worried about a stock market crash, which is particularly relevant if you're in drawdown and you can't make that capital back, and volatility is much more important when someone's just retired, as everyone knows, then if we have a sharp fall in markets, then government bonds have consistently been shown to be our best friend in that environment. That doesn't mean that they won't act as a drag on returns. It doesn't mean that if inflation becomes permanent, there won't be a rise in government bond yields and you'll lose money on your government bond holdings. But then you can think of them like insurance policy. Now, an insurance policy costs you money. In most circumstances, the best outcome for an insurance policy is it does cost you money because something's gone seriously wrong if you get paid out on your insurance. So it acts as a drag on your overall income, on your overall wealth, but it's there when you need it. Now, not in all circumstances, but you want an insurance policy that's going to pay out in most circumstances, the best insurance policy that you can have. And so we, with government bonds, we think for that crash scenario, the one that we're worried about from a client psychology point of view, because that tends to be when you get the panicky phone call, or from a retirement point of view, then we still think that government bonds has efficacy there. And of course, we've seen that really over the last couple of weeks as the Omicron variant came through. So a very sharp fall in bond yields that help protect investors that held them. So we still think there's benefits there. That doesn't change the fact we think that they are a terrible investment at the moment. They're just a reasonable insurance policy. Let's move on, Martin, from that side. So if you're not looking at government bonds, what other forms of diversification can you get? Well, one thing that other investors I know are enthusiastic about at the moment is higher risk bonds. So they could be emerging market debt, or high yield bonds, or even diversification through equities. And what this chart does reflects some research that we've been doing about the behavior of different asset classes in a whole range of economic and market scenarios. And what we can see is in this chart is the upside and downside capture ratio of different asset classes in different market environments. And the green is the upside capture ratio. So how much of a broad market upside does this particular asset class capture, and how much of the downside does it capture in red? And what we can see from this is that if you go to the far left-hand side of the chart, that there's some asset classes that capture very little of the downside. So things like emerging market bonds there, and even high yield bonds tend to capture less of the downside than equity asset classes, and so have a role in portfolios because they can provide some additional diversification, additional downside protection, but of course they all still capture some downside. So you still have a correlated asset. It's not like government bonds where you tend to get a negative correlation during crisis. Not always, but you tend to. And so in this scenario, this might slow down the decline compared to other assets that you have in the portfolio, but they're unlikely to do the job of a true diversifier. But of course, they have more upside capture. So portfolio managers like having them in portfolios and hoping that they act as diversifiers because they'll provide greater returns. But of course, when markets are going up very quickly, you don't need greater returns. You need the robustness that comes from a genuine diversifier, an effective insurance policy. Just be careful where people are putting high risk assets in portfolios as diversifiers, because actually you may not get the benefit of that when you need it, even though it feels clever when you don't need it. So there's certainly a place for these things in portfolios, but they won't necessarily provide the protection that you need. So let's move on then to the next slide, and we can see here one of the challenges that we have in relying on things like these higher risk bond markets and low risk equities as diversifiers. This is what happened in 93, 94, which you'll remember was when the Fed raised rates unexpectedly and caused turmoil in the bond market. And you can see in this situation that actually some of those assets that appear to perform well actually did very, very poorly, while others that do poorly in most market environments tended to do well in this environment. So again, when thinking about crash protection, it's really important not to take an overly simplistic view and look at just one scenario and what works well in one particular environment, but to look at a whole range of scenarios and really look at the robustness of the portfolio, the robustness of asset classes across that range. And that's what we do. I'm sure that's what any thoughtful investment manager does, but don't focus on one type of outcome, focus on a whole range. Martin, let's move on again. So let's go more on to managing downside risk in general then, so not just market crashes, but more broadly that downside risk. And the first thing to say is that downside risk comes from two key sources. The first is fundamental, and the second is valuation. So if you own a fundamentally weak asset where the cash flows are impaired, then you'll probably lose money over the long term. If you own an asset that's too expensive, then you can well lose money over the short term as that sells off. And we'll start with the second challenge first. And so if you flip over to one more slide, please, Martin. There we go. Sorry, I was expecting this quote to come up later. So could you go back a slide, Martin? There we go. So apologies. So you'll have seen this slide many times before if you've been working with Morningstar for a while, and this shows the impact of valuations, of starting valuations, on subsequent drawdowns. And it's entirely intuitive that if you buy assets when they're really cheap, you have lower subsequent average drawdowns. If you buy assets when they're really expensive, then you have higher subsequent average drawdowns. Now, if we look at the world as it is at the moment, then because asset prices are much more expensive than normally are, particularly pockets of assets like US technology companies, US consumer discretionary companies, then we have a situation where there's a lot of potential downside risk, far higher than normal, built into those assets than you'll see in other assets around the world. So, for example, energy or Chinese stocks or UK equities. Now, that is valuation driven downside, and that comes from things that are that are priced above their fair value. And that's really what we're seeing in some parts of the market at the moment. So there's an elevated downside risk that comes from valuation. But as I said, it's not just about valuation, it's also about fundamentals. So Martin, if you go forward one slide. Sorry, that's it. And this is the one I wanted to get to. This is a quote by one of my favorite investors, Howard Marks. And again, you'll be familiar with this if you've been working with us for a while. And Marks said that intelligent diversification means not just investing in a bunch of different things, but in things that respond differently to the same factors. And that's absolutely key. Sometimes you can buy a whole range of assets, but if they're all driven by the same factors, then you get no diversification. And so again, be careful about just having diversification by name in portfolios. Make sure that the underlying work has been done to understand the fundamental diversification. That's what we'll go on to next. One more slide, please, Martin. There we go. Thank you. So what we've done here is looked at the fundamental risk in two asset classes, which are very much in the news at the moment. The first is Chinese equities, and the second is world energy. And what we've looked at is the probability weighted things that could go wrong, the most important things that could go wrong for these asset classes. And so you can see those in front of you here. So for example, if we think about China, there's the impact of the antitrust crackdown. There's potential that could get worse. Social equality issues, the US forcing the delisting of VIE companies that are listed in the US and typically based in the Caymans. And we can think about a probability of those events happening. You can see here we've got 60% at the top because that's happening at the moment, down to sort of 1% at the bottom. And these are just our views. The real probabilities could be different. These are just our best views based on the work that we do. And then from that, we can estimate what the fair value impact of those risks will be. And then we can multiply the two together and say, well, we think that there is a downside to a long-term fair value of about 10%, 10.2% for Chinese equities at the moment. And then we can look at the price and decide whether that discounts more than a 10.2% decline in the fair value. And we think actually that Chinese equities at the moment look attractive because we think those risks are more than adequately discounted in portfolios. And then we can do the same thing when we think about energy companies immediately below. And here we have risks like the carbon emissions and the waste product, very high probability, high impact. Then you can look at operational health and safety, lower probability, low impact. And again, you can do that weighted calculation as well. And we can see that, again, because of all of those risks, which are primarily ESG type risks, then we should probably take about 11% from a long-term fair value of energy companies and then compare that to the current price. Now, and we also see energy companies as expensive, as attractive as you probably know. But as we look at this, the key is that the risks at energy companies aren't the same as the risk for Chinese technology companies or Chinese equities in general. And so by having those two in portfolios, they may both be volatile, but they have different driving factors. They're both risky. They both have significant risks. We believe those risks to be offset by the discount in the price at the moment, but the key is they have different risks. They're likely to behave differently. There'll be some market correlation, of course, but overall they're likely to behave differently, and that provides some diversification within the equity element of the portfolio. And then if we could scale that up, Martin, the next, thank you. We could then scale that up to a portfolio level and look at different market scenarios. So this is the Eurozone crisis. And we could look at what the potential drawdown would be in a current portfolio, where that drawdown would come from, and what the diversification benefit would be if we had a rerun of the Eurozone crisis. Of course, you never get a precise rerun, but there are certain iconic scenarios which we can look at and compare the portfolio against. So again, it's not just about the level of risk or the correlation of risk, it's then how you scale that up by thinking about the weighting of different risks in portfolios. So when thinking about the future, it's important to not focus on one particular risk, but to look at a whole range of risks, think about the probability attaching to those risks, and then make sure that's fully encompassed in your portfolio construction process as you build up these portfolios. And that's how we're going to build a robust portfolio, whatever 2022 brings us. Martin, if you could move on. So let's think about inflation then very briefly. I appreciate we're running out of time. So investing for a real return. And this of course, is the response to inflation. That if you are concerned about inflation, particularly concerned about the possibility of higher inflation, then your focus needs to be on delivering a real return. As you know, we have real return focused portfolios that are designed to do precisely that. But I want to sort of take a step back and look at how we think about that the way of combating inflation. And so the first thing to say is that everyone knows there's a higher risk of higher inflation as we look forward. That is not an investment insight. There's what the actual probability is. It could be an insight, but in reality, it's just a best guess. But what we know is that markets have already responded to the probability of higher inflation by pricing in higher inflation into the traditional assets that protect against inflation. So here's a chart of the break-even rate at 5 years and 10 years for US Treasury inflation protection securities. So these are the classic response to concerns about inflation. And you'll see that last year, the break-even inflation rate, the inflation rate at which you'd be better off owning TIPS, inflation protected bonds, rather than conventional bonds, was very low. And that's when we started adding them to portfolios in size, because we didn't think that reflected the future. Equally, now we see very little value in these assets because they're so expensive. There's some value, but far less than there was, because everyone's thought about this already. Martin, moving on, please. There we go. And so another way of looking at it is to look at the response to inflation in a whole range of different environments. And again, this is research that we've done at an asset class level, looking at how different assets respond in different inflationary environments. But the important thing to remember here is it's not just high and low inflation. There's really 4 different scenarios you need to think about. High inflation with high growth, high inflation with low growth, and low inflation with low growth, low inflation with high growth. Of course, the two that people are worried about is high inflation, whether it comes with high growth or low growth. But the important thing is that assets actually respond differently, whether you're in a high inflation, high growth environment or a high inflation, low growth environment. So in one of those, energy will perform much better. In the other, it won't nearly form the protection you need. And so again, rather than focusing on one environment and on one simplistic model of we're concerned about inflation, we need to think about the probability of inflation across the whole range of outcomes, and then the precise way that inflation may be manifest, to make sure that portfolios are robust against high growth, high inflation, as well as high growth, low inflation, and not being too certain in the forecast that we make. Martin, moving on, please, thank you. So this is some charts showing how our real return portfolios have done against their inflation benchmark. They're scaled to protect against different deliver different real returns over and above inflation. The reason I'm showing this is because the important thing is if you build a portfolio to be robust against inflation, it's going to be different from a portfolio that's designed to be risk-based or peer-aware. And so you're going to end up with a different investment journey. You can see that from these charts. It's be different from our target risk portfolios or from other objectives that we have. And so if you're concerned about inflation, have portfolios that are focused on inflation, but of course you have to educate your clients that their portfolios are likely to be better suited to their objectives. If their objective is to beat inflation over the long term, managing longevity risk, thinking about retirement, dealing with inflation concerns, but they're going to behave differently from other portfolio objectives, and so they're not going to be directly comparable against peers and typical benchmark indices. So be aware of that. When you have a different objective, you're going to have a different journey, as long as it's managed properly. So I have some key takeaways here, just as I finish. I'll let you read them through to yourself rather than me going through them all with you. But the key is to remember that the future is uncertain. There's a whole range of possible outcomes. The key with building portfolios is to build portfolios that are robust to that range of outcomes, to be thinking probabilistically, to understand how different assets will perform in different outcomes, to have a diversified portfolio which is driven by assets that respond to differently to the same stimulus, and make sure that your objective is tied to your portfolio construction, rather than just hoping that a portfolio objective, a portfolio structure will hit the objective you need. With that, I've taken far too much time. I apologize for that, Martin, but I'll hand back to you now for the rest of the webinar.
Yeah, thank you very much, Dan. That was very insightful. Really appreciate it. There's a couple of quick questions, so we'll just rattle through these, and then we'll bring it the year to a close in terms of webinars. One that's come in from the audience: will the UK financial markets improve on their relative underperformance in 2022? Oh, you're on mute, Dan.
Sorry, that is a great question. And of course, if you think about what I've just been saying and we think about the future probabilistically, then there's actually no way of predicting that with any certainty. What we can say is that there's a higher probability because of valuations that the UK will deliver better returns over the next few years than the US, for example. It's not cast in stone, and so you want to be careful about how much capital you put against that view. But certainly, I'd much rather a bigger position in the UK and a smaller position in the US, because we're finding business that fundamentally look good and have that valuation advantage, which gives them an edge probabilistically. And so that's how we're positioned. But that's not the same as saying we'll have no US and all UK because there's only one outcome. It's not like that. It's probabilistic, and you need to think about it in those terms.
Thank you, Dan. There's a raft of other questions, but given the time, we'll make sure we get back to people individually following the webinar. I just want to give a quick update on the webinar following the webinar last month, which was on ESG, that we've now launched the portfolios on 4 more platforms with more to come. And these are nearing their 3-year anniversary in April. So be on the lookout for those. They've been added to Aviva, Aegon, Hubwise and Nucleus. And I'm sure our business development managers will be in contact to discuss further. So in just closing out the webinar, a reminder of our suite of funds, the multi-asset 40, 60 and 80, which are a blend of active and passive funds and ETFs. They were launched just over a year ago. So we just reached our 1-year anniversary. So you'll start to see them come up more on your radar. So be sure to take a look at those, because we're not just about our DFM managed portfolio service anymore, of which we've got a huge raft. And Dan mentioned the real return. We've got ESG, active, passive, blended, international, to name a few, and income, I should say. So there's quite a raft to select from for your clients, and we'll be sure to be in touch. Now, CPD certificates and a link to the recording of the webinar will be sent out in the next 24 hours. And just a final word as the obligatory disclaimer slide is up. I just wanted to say our next webinar will be in January 2022. So do keep an eye on in your inbox for an email with registration details. A few final thank yous. A big thank you for Dan for stepping up to present today. So I really appreciate that. And thanks to all our speakers over the course of 2021, and also the tireless work of pulling these together from Keith Speck, our portfolio specialist, the whole investment team, as well as Amir, Gotchin, Aisha, and most importantly, a big thank you to you, the listeners, the advisors, the paraplanners and support staff who have dialed in continuously throughout the year. Thank you for your support of our managed portfolios and funds throughout the year and every year. And we wish you all the very best for the festive season. As always, if you'd like to know more about our portfolios and what we offer here at Morningstar Investment Management, our business development team will be sure to be in touch, and we will see you in 2022. Goodbye and thank you.
Thanks, everyone. Bye-bye.